Hey guys, how's it going? It's Andy from Magoo Investing. Happy Wednesday. So far this week, we've talked about a lot of stocks. On Monday, I talked about 5 stocks that I love going into 2020. These were mainly safer stocks. I talked about one stock that was at a discount that I really liked, talked about 3 blue chip stocks, and then I finished up the video with a stock that has a lot of upside potential. Yesterday, I talked about the cheap stocks that I like going into 2021, but cheap based off of being at a discount, not because of a low dollar amount. And then today I wanted to talk about dividend stocks that I like going into 2021. Dividend stocks, in my opinion, is something that's really overlooked by the younger generation of investors because dividends aren't as sexy as buying these stocks that'll likely double in the next year. But with dividends, you get a lot of overall stability. And I tried to pick some stocks. All of these stocks have relatively high dividend yields, which make them very attractive for long-term plays, and they still have a lot of upside potential. 4 out of 5 of the stocks that I picked are at a significant discount in 2020, have a lot of upside potential based off of the stock price, and pay a very nice dividend. Just a reminder that I do put timestamps in the description below. Say I get to a stock that you don't really care about, you can skip to a different part of the video and find a stock that you're actually interested in. So before getting started, I do have to say that I'm not a licensed financial advisor and this is not financial advice. Anything here in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, really appreciate it. Hit that like and subscribe button, as would help my channel out a lot. Also, if there's a stock you'd like me to go over in a future video, be sure to leave it in the comment section down below and I'll get to it as soon as I can. So the first stock on this list is going to be AbbVie, ticker symbol ABBV. Currently AbbVie is trading for $100 and it's up 13% on the year, and it pays a dividend of 5.2%. So this is a stock that's done pretty well in 2020 and pays out a very nice dividend. So AbbVie is a biopharm stock that was a spinoff from Abbott Labs, which is also a publicly traded stock with ticker symbol ABT. AbbVie came onto my list after Warren Buffett made a bunch of purchases, and AbbVie was part of it. At this point, Warren Buffett does own 21.2 million shares. And that's kind of why it caught my eye. Last year, AbbVie bought the Botox company Allergan, and fun fact, the chemical that's used in Botox, which is the botulism toxin, and so it shuts down a lot of the nerve endings and it makes it so wrinkles don't form. But it's really interesting because it is one of the most toxic substances on the planet. With the pandemic, we've seen a lot of the kind of operations that can be put off not happen. So for a company that owns Botox stuff, they have not been doing as well. From the July earnings report, the company saw a 43% drop in Botox sales, and while they posted a loss, their overall revenue increased by 26%. But their report at the end of October was much better numbers for Botox. They saw a 70% increase from the previous quarter back to the numbers that they saw. There are some worries about the long-term potential of AbbVie, more specifically because their most important drug, which is Humira, which is used to fight arthritis, has been not doing as well as there's been a lot of other competition on the market, and their profit margins are kind of shrinking because of that. But this acquisition of Botox and the parent company that owns it has done very well for them, and their revenue has been increasing significantly. At this point, their revenue is up 52% year over year because of that acquisition, and that's one of the main reasons why I feel very good about the company going forward. Looking at the dividend, it pays a 5.2% dividend and has a payout ratio of around 50%, which is very healthy. I do want to point out that payout ratio is the percentage of net income that is paid out in a dividend. So the higher that number is, the more risky it's going to be. It'd be like the equivalent if you're making money at a job and how much money you're paying for rent. The higher that number, the less money you're going to have left over. And so for a company that pays a high payout ratio, you have problems like they're not going to be able to invest in themselves in the future. They're not going to be able to do stock buybacks, and it just limits the ability for the company to operate at a healthy manner. So anything below 65-70%, in my opinion, is pretty healthy, but some people will argue on what numbers that they like. And so the stock only does have 7 years of dividend growth, but the stock has only been publicly traded for 7 years, as I mentioned that it did spin off from ABT. And they have increased their dividend every year since they've been public, so that's a thumbs up for me. Looking at the 5-year history for AbbVie, ticker symbol ABBV, compared to the S&P 500, we're going to look at them with both dividends reinvested. With dividends reinvested, AbbVie has had a very nice return with an average annual return of 15.6% compared to 14.1% from the S&P 500. And even without dividends being reinvested, it still has outperformed the overall market. With that out of the way, let's hop on the computer and I'll talk about what I see with the charts for AbbVie, ticker symbol ABBV. So here we are looking at AbbVie, ticker symbol ABBV. And unlike a lot of the stocks we're going to be talking about today, the stock has moved a lot on its own. Normally when you see dividend stocks, they're very stable because when you have that dividend payout, normally what you see is when the stock goes ex-dividend, it drops the same amount that was about to be paid out. And with AbbVie, it's actually been moving a lot on its own. You had this crazy move up to its high of 125. It has fallen. It hit this very nice support, which was tested again during the pandemic lows. and it bounces off of that. So there's actually a lot of zones, and based off of what I'm seeing here with the top, we are at a very interesting spot. The company is at the very top of this bound. It has just broken the $100 mark from yesterday's video. I talked about anytime a stock hits a very even number like a 100, 200, it usually acts as a resistance, and that's kind of how I've charted it out here. And so if it breaks above that, I do want to see the gap fill, which is something I'm going to talk about in like every video. So I would have my price target as 110. That is only around 10% profit, which is very nice. You put that in addition to the very nice dividend that it pays out, and this could be a fantastic play going forward. However, until it breaks above this area, I will set an alert just above it in case it breaks above that, because this is at a very interesting spot for the company. If it breaks above this, seems like decently clear sailing up to the upside, but if it falls, I'm looking forward to going back to the around $90 area. So it's kind of a 50-50 on your risk to reward ratio. You have the 10% upside, and you also have the 10% downside to the next support. So this is not something that I would buy in, and if it fell out of this current resistance, I would panic, because 10% is not horrible, especially when you're getting that very nice dividend. So as of right now, I'm going to put this as a hold until I see it break above this area, and if it gets above that, I will give it a buy rating. So the next stock on this list is going to be 3M, ticker symbol MMM. Currently 3M is trading for $173, and it's down 2% on the year, and it pays a 3.4% dividend. And so while it's not as attractive percentage-wise compared to something like an AbbVie, I still think 3.4% is pretty nice. Compare this to some of the dividend stocks I own. You wouldn't really think of them as being dividend stocks, stuff like Apple, Microsoft, Nike, that do pay a dividend, but these are companies that you would mainly buy because of the dividend. So 3M makes a total of 60,000 products, and they mostly do stuff in worker safety, healthcare, and consumer goods. You would consider 3M to be a cyclical company, which means that it follows the ups and downs of the overall economy. When I think of cyclical stocks, I think about stuff like Caterpillar, which spending on construction usually goes up when economic times are looking very good, and 3M kind of follows the same pattern. But with the overall pandemic, even though we may be seeing some tough economic conditions, their healthcare area of their business has been doing very well and has bolstered them during this tough time. When I do put up the revenue chart, you can see how steep of a decline in revenue the company had back in around 2008 with the last recession. So as I mentioned, their sales from their safety products has boosted them. From their last earnings report, they topped expectations as their safety and industrial division sales increased by 7% year over year, and their healthcare segment jumped 25%. But I do need to talk about what happened a couple years ago. Whenever I look at a stock and I see a large drop in price, I do need to figure out what happened there. With a lot of the stocks I talked about in this video, the drops are mainly from the overall pandemic hurting, but the company has been falling since like 2018, 2019. In 2019, it was looking like the economy was starting to slow down. As I mentioned, it's a cyclical company, so when you see companies like 3M start to struggle, you kind of expect the overall economy to follow suit. The company cut 2,000 jobs after they had slower than expected 2019, and they lowered its full year guidance. So the company was not looking that great going into 2020, and then the pandemic has kind of helped them a little bit by boosting some of their businesses that weren't doing as well. So as I mentioned, it has a 3.4% dividend with a payout ratio of 68%, which is, not that bad. It's on the higher end that I would like to invest in, but it's still pretty healthy. Their 5-year annual growth rate has been 11% for the dividend, and they have 62 straight years of dividend growth. So this is a company that's been around for a long time, and they have a track record of steadily increasing that dividend, which always looks great. Compared to the S&P 500, they've only had 4.9% for annual returns, compared to 14.1% from the S&P. But with that out of the way, let's hop on the computer and I'll talk about what I see on the charts for 3M, ticker symbol MMM. Okay, so here we are starting off the video looking at 3M, ticker symbol MMM. And the first thing that I kind of noticed was it almost feels like the stock moves kind of like a roller coaster. I was able to chart out this upward channel that was going for a long time. This started back in 2013 and had been on the up and up for a long time. You can even go further back, and it was just chugging along. And then it came up to the top and had its high at 260, which is crazy how high it went. And then we started, it's almost like it flipped, and it has just been going down ever since. And that's not a great thing when you're looking to buy a stock, but the way that I've charted it, it looks like we might have just broken out the top end. As I zoom in over here, you can see that we had this gap up to the very top. This giant red candle means that it closed the day before at 163. It opened at 174 after some good news. If this is the 9th, is probably the Moderna news. It jumped up and then it fell back down. And so that was a failed breakout. It tried to break out, when is this? This is the end of October. Tried to break out, failed, came back down, tested the 200-day moving average, which has been used as a support recently, and now we get this move up. And so based off of that, considering how long this downward channel had been going since 2017, I'm feeling very bullish on 3M just based off of that. Anytime you break out of a multi-year trend, that's always very bullish. And considering how much room it has to go to the upside, fantastic. Something I always talk about is I want to see gap fills. And the gap that's kind of sticking out to me is this area right here after it fell after poor earnings. It was towards the top of the channel, and usually going into earnings, I want to be able to see the catalyst from that earnings report be able to break through that. However, it was poor earnings and it just started a tail slide for a while. But now that we're above that, I'm feeling pretty bullish on this. In addition to the very nice dividend, I'm going to put 3M as a buy in my opinion. Next up, I wanted to talk about some of the oil and gas stocks, because when I think about companies that pay huge dividends, it's a lot of the older companies. This is because dividends just aren't as attractive at this point anymore. You don't see a lot of these new companies that are going IPO coming out with dividends. It's something that a lot of the older, more established companies have been doing to keep investors interested for a long time. And the stock I wanted to start with is going to be ExxonMobil, ticker symbol XOM. Currently it's trading for $38.50 and it's down 45% on the year. And while that doesn't look great, they do have a dividend yield of 9.5%, which is very high. 2020 has been a tough year for oil. If you haven't been paying attention, there was a time when the oil futures dropped below zero, which was really interesting. I had to explain to a lot of people what that really meant. But from the analysis that I could find, oil has recovered to around $41 a barrel. For most of the oil companies to break even, they're going to have to get up to $50 to $60 a barrel. And at this point, this analysis that I found shows that ExxonMobil has a higher break-even point than the other two companies, being Shell and Chevron. Their last earnings report was really bad. That's like an all caps bad, as I have in my notes. The company reported its third straight quarter with losses, which is never great. They lost $680 million, but are starting to see, quote, early stages of demand recovery. They reduced their spending program from $33 billion down to $23 billion, with a target to get that down between $16 and $19 billion in 2021. So the company has been seeing a tough time with the demand, and so as a result, they're trying to cut down spending to save as much money as possible. And while the company has struggled, the company keeps saying that the dividend is going to be a priority for the company. And so that gets to the discussion of, is this dividend going to be healthy? At this point, they say it's relatively safe, but we have been seeing some things recently that may show that it's not super safe. For the first time since 1982, they did not increase their dividend, which makes sense now because the dividend yield is up around 10%, which is, if they increase it anything above that, I'd start to get kind of worried. In August, the stock was removed from the Dow Jones after being a part of it since 1928, which was the longest tenure of the Dow Jones. So it has been replaced by a software company, CRM, and that kind of shows the switch of the US economy. The Dow Jones is supposed to be a representation of the largest companies in the US, and now that oil and gas stocks have not been doing as well, they have been removed from the Dow Jones, which is something to pay attention to in the future. Exxon has said that they won't be taking on any more debt at this point, and it is a high-risk play. This is not a stock that I would buy in because it's going to bounce back relatively soon. The high dividend gives it some stability where I'd be comfortable owning it for a little bit to see if it does recover when oil prices go back up. But at this point, it's looking pretty tough. They have close to a 10% dividend yield at this point with a growth rate of 4.9%, and they have 38 straight years of dividend growth, which recently came to an end, as I mentioned, because they did not increase the dividend. They've had some tough returns over the past 5 years. The annual growth rate has been negative 9.5% versus 14% from the S&P 500. So this is a stock that has significant upside because of the discount that we're seeing of down 45%. But at this point, let's hop on over to the computer and I'll talk about what I see on the charts for ExxonMobil, ticker symbol XOM. Okay, so here we are looking at ExxonMobil, ticker symbol XOM. As you can see, I've charted out there was a pretty steady decline going for a while in this channel. And the way that it broke out of this, I always talk about the way that you break through a support or resistance is a catalyst. And the catalyst, like a lot of stocks this year, was the pandemic. As you can see, this starts at the beginning of the year. We had some of the oil problems, and then once oil prices go down to zero, it falls all the way down. So when you go back, the company has been horizontal, flat for a while, and then it had fallen. And now we're getting some nice support down here. The stock bounced off the very bottom, rallied for a bit, and has kind of constantly slid for a while. But based off of the last earnings report, we did see it jump a little bit. The loss was better than expected, but the stock still has a long way to go. Something I'd be waiting for is a golden cross. somehow, based off of probably this move to the upside, the 200-day moving average is still lagging behind significantly. So until that happens, I'm not feeling super great about it. It is bullish that it is above the 50-day moving average, which it hasn't done since June. So that's slightly bullish, but overall, based off of the fundamentals, I will call this kind of like the American Airlines of oil stocks. It has a lot of upside considering how far it's down in 2020, but there's so much risk associated with it. But yeah, a lot of upside. So I'm going to put this as, I probably won't be touching, but this is something that I'll probably be checking up on in a couple months when oil prices recover a little bit. So now that we've talked about one of the hardest hit oil stocks, let's talk about my favorite, which is going to be Chevron, ticker symbol CVX. Currently, Chevron's trading for $87, and it's down 27% on the year. And when you compare that to being down 45% for Exxon, you can see that it's in a better spot. It has a lower dividend yield of 6%, but I think it's in a much better spot. If I kind of had to compare this to a different industry, I would compare this to the airline stocks, where ExxonMobil will be something like an American Airlines, ticker symbol AAL, where it's at a significant discount. And people may like it because they think it could recover because it does have this name recognition that you have with these massive companies. But I think Chevron, something closer to like a Delta, where it is a very large company as well. It hasn't fallen as much, but I think it has a lot of overall stability compared to its competitor. So similar to Exxon, the company has had a tough time. Their last earnings report saw a 30% drop in revenue and a total loss of $207 million. And while that does sound pretty bad, when you compare that to the almost $700 million that Exxon lost, it looks a lot better. Especially when you realize that Chevron has dethroned Exxon as being the largest US oil company, it makes you feel a lot better seeing the net loss compared to these two companies. So the company has cut spending by 48% in the past quarter to try to kind of save as much cash as possible. That's going to be a common theme with these oil stocks that have just been beaten down. And while the company has struggled, they've been able to pull in $8.3 billion of free cash flow, even though that is down significantly from the $22 billion that we saw a year ago. But the company has said that the dividend will stay safe through at least 2021, even if oil remains weak. At this point, I am expecting oil to bounce back by the end of 2021. So I'm not as worried for a company like Chevron that can, last that long until the end of 2021 when I don't feel as confident about something like an XOM. And so at that point, based off that chart I showed, they are at the lower end of the break-even point where they only need oil to get up to $50 a barrel. So I'm feeling pretty good about Chevron overall. As I mentioned, they have a 5.9% dividend with a 2.5% growth rate and 33 years of growth. When you compare it to the S&P 500, it is not negative like something like an ExxonMobil. It's at an annual return of 3.6% with dividends reinvested compared to the 14.1% of the S&P 500. So at this point, obviously it's not been doing as well as the overall market, but you're buying a stock at a discount with a very nice dividend. But you do need to think about the long-term potential of these companies. I am going to be making a video in the future talking about green stocks to buy because I think the world will be switching off of oil in the next 50 years. So this is not a stock that I would consider a buy and hold forever because just the longevity of this business is kind of in jeopardy at this point. It's not going to be going away in the next couple of years, but 25, 50 years down the road, we're not going to see as much demand for oil, hopefully. With that out of the way, let's hop on the computer and talk about what I see with Chevron, ticker symbol CVX. So here we are looking at Chevron, ticker symbol CVX, and I'm kind of lacking on drawings. This is a stock that I looked at for a long time, just trying to find some good zones to draw. And up here, you don't really have any common denominator when it comes to a resistance area. I was able to draw this because it's been respected as a support once, twice, 3, 4, fell through it because of the pandemic, and then struggled to break through it again. So this is a solid area around the $104 area. But when you look here, you have the recent news with the vaccine that pushed it up, and we're actually getting the price action is above the 200-day moving average, which is pretty bullish. And so this is a stock that I would have the upside be up to this resistance area, but there's not a great solid support for me to chart out. As I mentioned with, AbbVie? It was a very solid support below it and a resistance above it. So I could see that the risk to reward ratio for me would be 1-to-1. There's 10% upside, 10% downside. With something like this, I'm not feeling that great. I do see the gap right here that will probably need to be filled eventually. But right now, I don't know. It's just kind of in the middle. I don't see a lot of great technicals to base my trade off of. But compared to something like an Exxon, I think the fundamentals for this company give it closer to a buy rating. But since the technicals are not fully there, I don't feel comfortable buying in at this current price. The last stock on this list is going to be one of my favorite dividend stocks, and it has been something that I've owned in 2020. I no longer own it, but it's one of my favorite stocks, being AT&T, ticker symbol T. Currently, AT&T is trading for $29 and it's down 26% on the year with a dividend yield of 7.6%. While the company has struggled for a while, I think AT&T could be a great opportunity. The main reason behind that is it's at a significant discount. The stock jumped with the dot-com bubble in the early 2000s, fell, rose, and now has fallen, and it's at a recent low. It does have a lot of competition with T-Mobile and Verizon when it comes to the communications company, and it limits the amount of pricing power that the company has. So the profit margins aren't going to be as high as they've been in the past, but the thing that makes me really feel good about the company going forward has to do with 5G. When you look at the communications companies that have the resources to actually invest in the 5G, it's literally only Verizon and T-Mobile. So the competition isn't that high. And the numbers that I'm seeing for 5G, the expectation is that the 5G tech market will grow at a compound annual growth rate of 122% through 2026. So this is an area that can be a huge boost to the company. They have made some questionable acquisitions in the past. They bought DirecTV and Warner Media right as the cord-cutting movement started, which haven't been great investments. But I think 5G gives them enough staying power that I would feel comfortable buying in and just kind of letting AT&T do its own thing. So as I mentioned, it has a 7.2% dividend with a payout ratio of 65%, a 2.1% growth rate, and 35 years of growth. I know the graphic says 20 years, but I've found it on multiple other websites saying that it's been increasing its dividend for 35 years, making it a dividend aristocrat. Its annual return with dividends reinvested is only 3.1% compared to the 14% from the S&P 500. But when I hop onto the charts in a second, I will explain why I think this is a very good value play. It is a well-established company that has a lot of upside with 5G. It's relatively stable and it has a fantastic dividend. So let's hop on the computer and I'll talk about what I see there. Okay, so we're going to finish the video off on AT&T, and it is a pretty boring chart for the past couple months. I charted out some areas. There's a very nice resistance up at around the $40 mark. This was tested back in the end of 2018, and it came down in the pandemic, and then recently tried it again. This is kind of a stock that I don't really care that much about the technicals, which kind of pains me to say because that's always how I've based most of my trades. AT&T is one of those stocks where I think it's just going to kind of go horizontal for a while. But the main reason you're in it is because it's a very safe business when it comes to a very nice dividend. Obviously, they've struggled a little bit when it comes to the share price. I'll zoom out and kind of show how it's done recently. It's been pretty horizontal since this is end of 2012 going into 2013. So this is not a stock that you buy because it has a lot of upside potential. I could realistically see it get back up to the $40 mark, which would be very nice. Considering it's at around 30, that'd be 33% profit. We'd love to see that. But based off of the very nice dividend, the stable dividend, and the fact that it's increased for 35 straight years, AT&T will pretty much always be a buy in my opinion. This is not something that I would buy for the crazy upside. If I wanted to get a dividend stock that had more upside, I'd probably go to something like a Verizon. But for a safe dividend play with high yield, I think AT&T, ticker symbol T, is a great option. So overall, these were 5 dividend stocks that I'm looking to buy going into 2021. If I had to rank them, I would go with AT&T being my favorite, then I'll go with AbbVie, 3M, Chevron, and then I'll finish off the bottom of the list being Exxon. I think Chevron is a very decent play. It just has more risk than I'm willing to take on at this point. But if we see oil prices start to rise and the demand starts to come back, I think Chevron could jump up my list to maybe second place. But I think these are all great options. I think dividend plays should be included in almost everyone's portfolio at this point. They're not as sexy as a stock that could double in the next year, but stable growth is how you build wealth, and I think these are great options. So let me know what dividend stocks I missed, or maybe I can make a part 2 with more dividend stocks that you guys are buying or that you love. So let me know in the comment section down below. Thanks for watching this video. I appreciate all the support, and I will see you tomorrow.